Hello and welcome to today's webcast titled Money, Debt, and Gold, Why Higher Gold Prices Are All But Assured. We have just a few announcements before we begin. The slides will advance automatically throughout the presentation. Should you need technical assistance, click on the help link. If your screen freezes or the slides do not appear to be advancing as they should, please try exiting and restarting the session, as it may be an issue with your connectivity. At any time, you can submit a question using the Ask a Question box located in the bottom left-hand corner of your screen. I will now turn the call over to Sonia Dore from Kitco Marketing so that we may begin. Please go ahead.
Welcome, I'm Sonia Dore from Kitco. Thank you for joining us today for Kitco's Coffee Break webinar, Money, Debt, and Gold, Why Much Higher Gold Prices Are All But Assured, with guest presenter Brien Lundin. Due to the overwhelming popularity of our website and questions we receive from customers on a daily basis, Kitco has decided to offer a series of free occasional coffee break webinars. Kitco's coffee break webinars cover a variety of topics, insights on the market, details on various products, and any information pertaining to the precious metals industry. Always under 15 minutes, our webinars are quick, informative, and designed to fit into your busy work schedules. So have a coffee, grab a sandwich, and enjoy the presentation. Today's guest presenter is Brien Lundin. Brien has 3 decades of experience in investment markets and currently serves as president and CEO of Jefferson Financial, a highly regarded producer of investment-oriented events and publisher of investment newsletters and special reports. Brien will be sharing his opinion today on why much higher gold prices are all but assured. Enjoy the presentation. Over to you, Brien.
Thank you, Sonia. You know, it wasn't that long ago that CNBC wouldn't lower itself to include gold in its scrolling market prices. Now, after nearly 12 years of rising prices, gold often dominates the headlines. But the metal has been volatile, especially recently, leaving many to doubt whether the bull market will continue. The most powerful factors driving Western world economies, however, are money and debt, and too much of both. And these factors argue for a continuance of the gold bull market, perhaps to levels few are now imagining. But there are some common fallacies regarding the interplay of money, debt, and gold that investors need to be aware of if they hope to profit from this megatrend. Here's a long-term chart of what has shaped up to be the greatest gold bull market in history, already greater in duration than the 1970s bull run, and therefore offering much more opportunity for profit. When you pull back and look at the big picture, you notice a few important things. First, the stomach-turning drops in 2006, 2008, and today turn out to be mere blips on the long-term trend. And second, we see that the trading channel can be extended to the very beginnings of this decade-long bull market, and that gold has never strayed from it. Even the current correction has yet to violate this bullish uptrend. Far from a bubble, this gold bull market clearly reflects the times we are in. When you drill in closer, however, you see how harrowing this market can be for those who follow it daily. Here we see that gold has gone absolutely nowhere since the peak last September. And in fact, the metal has been in the midst of a major correction. A closer view shows the recent correction much more clearly. In fact, since this chart was drawn, gold has rebounded. And as I'll show you in a moment, this latest drop may have marked an important bottom and the beginnings of a very powerful move upward. The 50-day moving average and associated Bollinger Bands has been one of the most reliable charts that I've been tracking in Gold Newsletter. As you can see by the red arrows, gold has gone from the lower Bollinger Band to the upper, and each extreme clearly rings a bell near the bottoms and tops in the market. In addition, whenever the Bollinger Bands pinch, it has preceded a rally in the metal. Since the end of last year, however, this effect has become muted, with the price rallies becoming successively smaller in degree. In fact, the price touched the lower band in early April, and gold barely moved in response. Now gold's touched that band once again, and we're still wondering what the eventual result will be. We looked at gold's uptrend trading channels since the beginnings of this historic bull market in 2000 and 2001. Here we see a very clear channel dating back to the credit crisis of 2008. As you can see, this channel has been violated thanks to the current credit crisis in Europe. In fact, on this chart, the current situation looks very similar to that of 2008. This is an important point, and I'll get back to it in a moment. Now let's look at a similar chart for silver. My late mentor and business partner, Jim Blanchard, was the original gold bug and proud of it. Jim used to tell me that gold bugs are crazy, but silver bugs are really nuts. This chart shows you why. Silver leverages the moves in gold to the upside and to the downside. While this offers greater risk, it also offers the much higher potential that gets speculators salivating. If you can buy silver on the dips, you can make real money. Obviously, we've just been in one of those dips. Now, this is a very important chart that you won't see anywhere else. Years ago, I noticed that gold repeatedly fell through the widely watched 200-day moving average, but eventually set right back upon the uptrend. So, working with my friend Ron Grease at thechartstore.com, I went looking for a more reliable support line. We found it in the 300-day moving average. As you can see, gold has repeatedly bounced off of this support throughout this long bull market. In fact, it has only significantly violated this support twice, during the credit crisis of 2008 and today. This tells me that the current situation is of a similar magnitude and importance as the crisis of 2008. At this point, it is still a mini-me version of 2008 or 2008 light, but it could develop into something equally momentous. And consider this. In 2008, gold fell 12.5% below the 300-day moving average. Extrapolating that to today, and a similar decline translates to gold price in the $1,428 area. Will we see that low? I don't think so, for reasons you're about to see. Now, let's assume that the similarities to 2008 continue into the recovery rally. The lesson to take here is that these types of corrections in gold have been very rare and have turned out to be exceedingly profitable. From its low of $720 during the credit crisis of 2008, for example, gold soared to a high of $1,920 in less than 3 years, a gain of 167%. If, and granted this is a big if, gold performs similarly this time around, it implies a gold price of $3,800 at the next interim high. Now, I don't think we'll see either extreme, on the low or high side, because the European crisis doesn't affect the global financial system to the degree that the 2008 credit crisis did. The question to ask yourself is simply this: does the current economic environment argue for lower gold prices or higher? If you say higher, then you're talking about much higher prices. Okay, we've covered gold. Now let's see how money and debt affect the metal and analyze some of the widely held fallacies. We'll work backwards, beginning with debt. Whenever I'm asked by reporters or others not intimately involved in the gold market why gold has been climbing for over a decade, I always tell them the reason is quite simple. Money and debt, too much of both. And of course, too much debt means that eventually there'll be a lot more money created to depreciate that debt load. This chart and the next few show the depth of the problem we're facing in the U.S. 18 months ago, when I showed this chart, total public debt was $13.56 trillion. 6 months ago, it was $14.79 trillion. Today, it stands about another trillion higher. This gives you some idea of the velocity in this trend. The next charts are even scarier. Here you see federal debt as a percentage of gross domestic product. In the U.S., it's now cleared 100%, a level that would push other countries off the debt rating cliff. Some argue that the U.S. can get away with this, since it prints the world's reserve currency. But if the very foundation of the global financial system is as shaky as its weaker links, then what does that say about the health of the entire system? Now, as large as the U.S. debt load has grown, the world still can't get enough of our debt whenever there's a sniff of crisis in the wind. Take a look at this chart of 10-year Treasury yields. As you can see, yields have now reached and exceeded the low of the 2008 crisis. 2008 was our crisis. 2012 is Europe's turn. They will undoubtedly choose the same path of monetary inflation that the U.S. took. Now it's time to take a quick look at what's been happening with the global money supply and how that's affecting gold. Some argue that because the U.S. adjusted monetary base has been stagnant in recent months, that monetary inflation isn't currently a factor for gold. But here we see that real high-powered money, as gauged by M1, has been soaring. This is all happening behind the scenes. But once we get through the current fiscal crisis, I expect the U.S. and European money supplies to rocket higher. And in turn, this will be a primary factor driving gold higher. As we saw in the previous chart, M1 money supply in the U.S. is pushing $2.6 trillion. But here's another factor that relatively few are considering. There's another $1.5 trillion in excess banking reserves overhanging the U.S. economy, ready to spawn rapid inflation. These excess reserves are held on deposit at the Fed, which pays banks about 0.5% interest on them. That's easy money for the banks, and these funds don't count as money per se until and if they are actually injected into the economy. So everybody wins until they don't. What happens when banks start to make loans when they can get 2, 3, or 4 points on that money? Once they loan these reserves out, they instantly and miraculously become money. So if and when the economy begins to really recover, this avalanche of newly created money will begin cascading out, and the inflation genie will be out of the bottle. As you can see, this is already beginning to happen. Now, let's look at how various economic developments and trends affect gold. As you'll see, we're going to slay a few more fallacies along the way. First, here's another unique chart that we developed with thechartstore.com. The idea is that because gold's bull market is supposedly based on money and debt, let's take a hard look at how gold's price action since the gold window was closed in 1971 related to growth in debt and the money supply. This chart rebases both gold and federal debt to 100 in August of 1971. The results were intriguing and a bit unexpected, since the correlation is not absolute. Here we see the price of gold, the green line, compared against federal debt, the orange line. As you can see, the rapid rise in debt during the 1970s powered gold higher. During the Reagan years of the 1980s, however, gold was flat to down even as the debt continued to rise at a steep rate. The reason? In my view, economic growth suppressed investor concerns over rising debt. Then, in the 1990s, the peace dividend and revenues from stock and real estate bubbles moderated the growth in the debt and depressed the gold price. But note how responsive and predictive gold was at the dawn of the century as debt resumed its rapid rise and market bubbles began to burst. Now let's look at money. This chart rebases the M2 money supply in gold to 100 at the closing of the gold window in 1971. Similar to our previous chart, it shows that changes in the money supply strongly influence gold, but economic growth and/or asset bubbles in other markets can moderate the effect of a rising money supply. Our next chart is especially interesting and surprising to many unfamiliar with how government attempts to rig the game. Now, you would think that gold would be highly reactive to retail price inflation. In fact, many gold skeptics use gold's non-correlation to the CPI as evidence that it isn't an inflation hedge at all. But this argument ignores two things. First, gold is more sensitive to monetary inflation. The more fiat currency in existence, the more currency it takes to buy the only real currency, gold. And two, today's CPI isn't Richard Nixon's CPI. The U.S. government changed the CPI calculation methodology in 1978, 1983, and 1996. Does anyone think these changes were intended to elevate the CPI? The fact is, they're using a longer yardstick to measure CPI today. And as you can see, gold recognizes this, as the correlation between gold and the CPI has been broken since these changes were implemented. I always like to end my gold market analyses with this chart of gold in real constant dollar terms. This shows that despite the remarkable gains of the last 11 years, gold still has a lot of headroom. Consider that the 1980 peak for gold was $850 in nominal terms, a level that is now far behind us. In terms of today's dollars, however, gold would have to trade at over $2,500 just to equal that 1980 high. As our earlier charts show, it could reach this level over the next few years, at which point we'll be literally in uncharted territory.
Thank you, Brien. We've been receiving numerous questions throughout the presentation, so we've randomly selected 3. If your question is not answered, we will try to respond to you by email, so please make sure that you've entered your email address correctly. Now to the first question. Why hasn't gold operated as a safe haven during the credit crisis?
Well, the answer to that is quite simply that gold is not a safe haven during economic crisis, or doesn't function as that currently. You'll see gold react somewhat to a crisis or bad headlines or some kind of economic downturn, but that's usually driven by speculators buying gold, betting that others will buy gold on the basis of that crisis. In fact, gold truly reacts only to long-term monetary inflation. And during the recent credit crises, we've seen really liquidity vacuums where speculators are forced to pull their hot money out of various bets, meet margin calls, and essentially go to cash to meet those margin calls. So gold has suffered immediately or in the aftermath of some of these fundamental shocks to the market, but it is the solution. It's a solution to these crises that really drive gold. Once the market understands that to get out of a credit crisis, for example, that there will be tremendous monetary reflation, then you see gold responding. The gold and gold investors understand that the solution to a credit crisis or to some of these financial crises is monetary inflation. It is the solution that central bankers always resort to, and gold reacts to that much more strongly and really only consistently to that type of development.
Okay, great. And I think that really ties into our second question. Someone has asked, why hasn't there been inflation yet? And in your opinion, will there be inflation?
Well, there are a number of reasons. I really don't think we're going to see the type of retail price inflation that we saw in the 1970s. I went over some of those reasons in my presentation with the changes in the CPI. Some of the other reasons are the impact that developing countries have on the global economy. Today, if we have a piece of furniture that breaks, for example, in the old days, in the 1970s or earlier, we would have fixed that piece of furniture or done our best to do it. Now we just go out to Walmart or Costco or Sam's Club and buy a new one. What escapes many analysts and many economists is the effect that these developing countries, these exporting countries with the low labor rates, has had on the U.S. economy in lowering prices, depressing prices, and in turn elevating the effective quality of life for lower and middle income citizens. So I think that's going to have a really depressing effect on the CPI, in addition to the fact that the CPI today is not the same CPI that we had in the 1970s.
Thank you. And now for our last question, completely on a different note, what are your expectations for silver?
Well, I think silver is going to follow gold. As you saw in one of my charts, silver really exacerbates the moves in gold to the upside and the downside. So investors can really make a lot of money and get a more secure form of leverage on gold by simply buying silver on the dips and selling it or trading it out of that position on the interim peaks. So wherever gold goes, silver will go. One of the fallacies that kind of dominates this market is, and that you'll see on CNBC and a number of these other analysts that are really intimate or familiar with the precious metals markets, is that they'll talk about silver as an industrial metal as well as a precious metal. The industrial component of silver really has very little impact on the metal at these price levels. Silver is where it is precisely because of the monetary factors in play and not the industrial factors. Those industrial factors are something to consider when silver was at $7.50 and you were wondering whether it would get up to $8.50. It's not something that really plays a role in silver in the high 20s and low 30s.
Thank you for attending the presentation. If you are interested in buying gold or any other of Kitco's products, please contact us anytime at 1-877-775-4826. Kitco will be hosting another free 15-minute coffee break webinar in June, so please keep checking our website for more details. The 2012 New Orleans Investment Conference will be held from October 24th to 27th. Thousands of investors will testify that this conference is the best place to learn how to protect and build your wealth during uncertain markets. Guest speakers include Sarah Palin, Charles Krauthammer, Dr. Mark Faber, Peter Schiff, Rick Santelli, Doug Casey, and many other industry experts. For participating in the webinar today, you are eligible for an early bird savings when registering for the conference. The registration to this renowned event is normally $995, but by registering through Kitco, it is $595. If you signed up for our email notifications, we'll be sending you the information by email within the next few weeks. If you did not sign up and would like to receive this information, please email us at events@kitco.com. Thank you all once again for attending the presentation today.
Ladies and gentlemen, we thank you for your time and attention. This webcast is now concluded.